Markets in Financial Instruments Directive in 2007 opened up Europe's trading landscape to market competition, which is the lifeblood of innovation and optimal customer service. Launched in October 2012, Aquis Exchange is owned by its staff, a number of high net worth individuals, and the Warsaw Stock Exchange, which has seen a 30% equity stake accordingly. Aquis has brought its own set of innovations to the market. It is clear that Aquis provides fresh competition to an increasingly concentrated European trading market and encourages growth through its subscription and pricing model. Customers are charged according to the message traffic they generate, rather than a percentage of the value of each stock traded. It also offers different pricing bands to accommodate varying degrees of usage. Alasdair Haynes, founder and chief executive of Aquis Exchange, explains the dynamics.
Yeah, Aquis is a pan-European equities stock exchange, introduced to break the duopoly that currently exists in the European equities markets. We started it about just over a year ago with the intention of introducing a completely never tried for before subscription pricing model, based on what we all experience now when sort of buying telephones. You go into a telephone shop today, you buy your mobile phone, you pay a subscription each month, you get free data, you get unlimited downloads, you get as many calls as you want. This has never been tried in financial services, and we decided that this was something that's very akin to what stock exchanges do. They are utilities. And under a utility model, when managing message traffic, that is exactly what we wanted to copy and replicate. Every time a subscription model has been introduced into an industry, it has seen exponential growth in that industry. We've seen it in mobile phones, we've seen it in television, the introduction of Sky, we've seen it with Netflix, we see it with Amazon Prime, so retail. And therefore, if you're trying to grow a market, there is no better way than to try and do this through subscription model.
Cash equity trading volumes, though still lower than the apex in 2007, look to be on the rise. Alasdair explains the salient trends.
Yeah, of course. I think what most people, when they set up an exchange, or most people who look at an exchange, look at market share. And of course, it's absolutely what we want to do is build market share. But market share takes time, and in order to build market share, you have to have liquidity. So what we've really focused on in the last year is about getting proper liquidity provision. And recently, we've actually seen statistics from a company called Liquidity, which they call the battle map. And what that does is it looks at the liquidity in each market and the spreads in each market. Very proud to say that Aquis in Switzerland, so the major stocks in Switzerland, in Italy and in Sweden, we're either the second or third best provider of liquidity in each of those markets. And not just liquidity at the touch, but actually liquidity in the depth of the book. And from that, obviously, as we build more and more customers, we get more and more people participating, then we would expect to see market share grow. So the real focus has been get liquidity first, build market share, and that's the stage we're at now.
Aquis is introducing the market at close MAC order type, which will allow traders to enter orders for matching on the Aquis Exchange platform at the closing price of the market of listing end of day auction. Exchange liquidity is often the highest either at the market open during the first 15 to 30 minutes of trading and near the close during the last 15 to 20 minutes of the trading day. Today, about 20% of all trading in Europe is conducted in the closing auctions. Fees charged at the auction are typically 50 to 100% higher at this point in the day than any other time as a result of the lack of competition. It means the closing auctions are a particularly lucrative segment of the market for exchanges. According to Aquis, the MAC order type has the support of both the buy and the sell side and is fully transparent and complies with MiFID II. MAC meets pre- and post-trade transparency requirements and, crucially, will not be subject to MiFID II restrictions for the use of reference price waivers. Alasdair explains the significance of the initiative.
This is a product we are very excited about. The MAC, which is the market at close order type, is something that is going to break a monopoly which is currently held by the national exchanges across Europe. What is important here is that roughly something between 17 and 20% of all equity trading is actually done at the closing price. And today, the closing price is actually established by a mechanism, an auction mechanism run by the national exchanges. And because this is a monopoly, they actually charge more to do this. So every person in Europe has to actually pay more if they want to trade at the close. What Aquis has done is we've got regulatory approval to run an auction prior to the market close, but actually using the price of the national exchanges. Now, the benefit of doing this, of course, is that if you pay a subscription, what will happen is it's already included in your price. Every piece of business you do on Aquis is at a marginal cost of zero. So you can now be able to trade at the close at a free price. In effect, it's free for you if you're a subscriber to Aquis. We think as I said, there's nearly 20% of business being done here. We think that is a phenomenal opportunity for us to grow and once again go into the market and break these monopolies that cannot be good for the industry.
Regulation and re-regulation in the European financial and trading markets in these days is a given. Important drivers of market regulation include the requirement to reduce systemic risk and improve market transparency. Regulators regularly review the operation of both dark and lit trading markets. Alasdair explains how regulatory oversight is affecting the operation of exchanges such as Aquis.
Market reaction is always a really interesting thing. It tells me, and having seen it in previous businesses that I've organised and run, is that when somebody reacts in a way quite aggressively, then you know you're actually touching a sore point, and therefore you're probably on the right track. In the case of the MAC and the closing price, we've already seen, I've had national exchanges calling me up in sort of disgust of what we're trying to do. We've seen all sorts of threats about changing price and trying to do things, changing actually data prices on us specifically to compete against us or to prevent our competition. And that it shows me that we're touching the right place here. We have great support from the buy side. We have great support from the sell side. And all of these things, it doesn't matter. Bringing competition in depends on if people want something. People want change here, and change is good for our industry. And frankly, it's time that this monopoly gets broken. So yeah, I think we've got a great chance of success here.
Wider market trends are also in play, which inevitably have an effect on both volume and class of securities traded. Shifts in asset allocation also have significant knock-on effects on different types of trading and trading strategies. A very visible shift out of cash equities has been visible for some years, but choices investors make between equities and bonds, or equities and cash, or equities and real estate is undergoing subtle shifts right now. What is Aquis Exchange's view of the drivers behind asset allocation decisions these days?
I think we're living in some very, very interesting times. Ever since the credit crunch, we've seen the markets responding to quantitative easing. Quantitative easing creates a sort of a period in history which is abnormal. That is not what I believe the long trend for market economics. Quantitative easing will finish at some point in time. At times of quantitative easing, people are going to put asset allocation really on a very short-term basis. And I think you've seen an input and an output of the equities business. Longer term, as interest rates start to rise and economies start to grow, particularly in Europe, there will be growth in the equities market. And one of the things that I've been saying for a number of years on top of this is that you look at the volume of trading in European equities. It is roughly a quarter of what it does in the United States. The population in Europe is slightly larger than that of the United States. The GDPs are very comparable to each other. There is no reason at all why the volume of equity trading in Europe shouldn't grow substantially. What it needs is a catalyst, and one of those catalysts for change is going to be the subscription model, which will change the way that people trade.